Well, hello, everyone, and welcome to the Benjamin Z. Miller Investor Networking Group. We've got an interesting presentation today on the topic of bond investing. If you're seeing this on the internet, the Benjamin Z. Miller Investor Networking Group, we have meetings every week and you can join the group. Just go to benjaminzmiller.com and fill out the contact form. We talk about different subjects, and you can meet investors from around the world. We've got investors from all over Europe and the United States, Canada, all over. So just join, and it's something, but we do a presentation topic. Today, we're talking about bond investing. And this is such an important topic, bonds, and we hear so much about bonds in the news. And if you have accounts at maybe Merrill Lynch or BlackRock or Goldman Sachs, a lot of these companies, they use different models. And one of the models that is used is modern portfolio theory. The origin of modern portfolio theory, in 1990, an economist named Harry Markowitz, he actually won the Nobel Prize for his work in modern portfolio theory. He's actually considered the grandfather of it. And it's a very complicated model, a lot of math. But when it came to Harry Markowitz's own portfolio, he did things a little simpler. Even though he had this complicated theory, when it came to his own personal portfolio, he just would once a year put half his money in stocks and half in bonds. And then if the stocks went up in value, he would sell stocks and he would buy bonds. And if the stocks went down in value, he would sell bonds and he would buy stocks, and he would adjust his portfolio every year. So that's the basics of it. What about the history of bonds? They have actually quite an interesting history. They were first issued by the Bank of England in 1694, and they were issued to help finance the war against France with Napoleon. And this is actually an interesting picture here. This is one of my favorite pictures. It's Napoleon's horse. This is in a museum in France, and you can see the brand. So makes it pretty real, this history. Very interesting. But bonds are a product of they were actually created to help finance wars. So there's several different kinds of bonds. One bond that's not commonly used anymore are called console bonds. Console bonds are a bond that doesn't have a maturity date. So the console bonds that were issued back then, they didn't have a maturity date, whereas nowadays we have bonds that have, they're maturing in 30 years, 20 years, 10 years, 5 years, whatever it might be, but they would actually issue console bonds. And those bonds stayed out for many, many years. Debts that were issued by Winston Churchill going back to the South Sea bubble, Napoleonic and Crimean Wars. So it's interesting, the history of bonds. Definitely something that's important. Speaking of the history of bonds, an interesting story is the story of Napoleon's defeat, when he ultimately was defeated, and how Nathan Rothschild made a lot of money in the bond market. So the Battle of Waterloo took place on the June 18th, 1815, and Napoleon lost. But there was not news back then like we have, where instantly we know what's going on. It could take time for news to travel. So when Napoleon's army was defeated, it took a while for the news to reach. So Rothschild, however, he got the news earlier, and there's a lot of stories about how he got the news earlier. There's rumors that they used a carrier pigeon that carried news, that flew and gave the news early. It may have just been a rider that rode faster, left earlier, but he supposedly got the news a day earlier, and that allowed him to know that because the loss had occurred, that made the British bonds valuable, because they were valuable now that this war had ended in Napoleon's defeat. But what he did was he went and spread a rumor that that in fact the British had lost. He had friends that were working with him, and the rumor was spread that the British had lost. And as a result of that, the price of UK bond gilts, when people found out that the British had lost, everybody wanted to sell their bonds. So they sold their bonds. They wanted to get rid of them as quickly as they could before the news spread more quickly. So the price collapsed. And when the price collapsed, Rothschild and his friends and associates, they swooped in and they purchased the bonds at steep discounts. And then a few days later, when the news arrived that, hey, he actually won, those bond prices went through the roof in value. So it's a great story, and it just shows that if you have more information, this can be really something that you can profit on. Of course, they have some rules now about inside information, but still an interesting story. So what's the relationship between the interest rate and the bond price? It's simple. When the interest rate increases, the bond prices fall, and this happens because a situation like that, it's less attractive to buy an old bond if you could buy a new bond that has a higher interest rate, and vice versa. So that's how that works. There's a lot of factors that impact bond prices. Interest rates are the first one, and that's the one that most people are aware of, but bond prices are affected by credit risk. That could be credit risk for a corporation, or it could be for a government. Economic growth can impact bond prices. And then, of course, actions of the central bank when they buy or sell, those can also impact bond prices. But what are the typical default rates on bonds? So if you take, for example, a very high rated thing like AAA rating, the S&P 500, that might have a default rate. It's very low, maybe 1 out of 192 times it would default. So almost never happens. Whereas if you move to a BBB rated, say you look at Fitch's rating, BBB, that might have a default rate of 2.98%, or 1 out of 34 times there'd be a default if you bought that bond. So it's something where you can kind of get an idea of default rate, but that's very important to not just rely on these rating agencies. And I've got a great example I'll talk about a little later. So people buy bonds, they're looking to get passive income. In the UK, bonds are called gilts. In the US, the bonds are called treasury bills or T-bills, and German federal bonds are referred to as bunds. So there's different names, but that's all the same thing, passive income. There's corporate government bonds. Those are important. And actually in Islamic finance, there's what's called a sukuk bond, which is developed as an alternative to conventional bonds. Since a lot of Muslims, they have a prohibition against interest, it's discouraged. So sukuk bonds are also floating around. A few terms you'll come into are yield. You hear that one a lot. Premium and par, I'll give an example of that. And then you also hear the term notes. Notes are usually when you're talking about a debt obligation that's less than 5 years, but it can vary. There's some flexibility there. And duration is one that people don't know as well as yield, but it's also important. Duration is the one that really hurts new bond investors that don't know what they're doing. Is they will do things like they will buy a long-term bond, and then the interest rates will, for example, go up 1%. Well, if the interest rates go up on a long-term bond by 1%, this can have a massive change in the value of that bond. This example here shows what happens on a 5-year bond with this concept of duration, where if the interest rates move 1% on a 5-year bond, the price is going to decline 5%. But if you were to be on a 20-year bond, you might get a 20% movement in price just by the interest rate going up. So the point of the story is that, and that also works the other way, where if you bought the bond and the interest rates went down, that could work in your favor. But new investors, if they buy long-term bonds and they don't understand duration, they can be shocked when they find out that, oh my God, the interest rates moved. I have a long-term bond. My bond lost 20% of its value. Yeah, that can happen. So that's why it's important to really know what you're doing instead of just buying bonds because it's fashionable. There's a calculation of duration. I'm not going to spend a lot of time on that. It's just a basic mathematical calculation where you can do it on you can do it on a financial calculator. You can do it with MATLAB, Sage, whatever you like to use, you can calculate it. So one of the myths that's out there is that rated debt is always safer. Okay, it's not always safer. I'll give an example here of one of the disasters called Enron, which was a U.S. energy company. And these same rating agencies that I showed, they were listing Enron as investment grade. And a lot of the investors that didn't look at the balance sheets, that didn't study anything, that weren't really following, they just were trusting the rating agency. They were blindly following the rating agency. They had a very unpleasant disaster. And those bonds, Enron, so on November 28th, 2001, the major rating agencies gave it an investment grade rating. But on December 2nd, Enron declared bankruptcy. So that's quite a disaster. That is quite a disaster. And that resulted in one of the largest bankruptcies in U.S. history. And those bondholders had tremendous losses. So you want to look not just at publicly traded debt. That's a big mistake, is just blindly trusting a rating agency. You should be smart, and you should look for bonds that are backed by hard assets. For example, mortgage notes. And a company that you might look at is Alamo Mortgage Holdings. And for purposes of disclosure, that's my company, but that company actually purchases mortgage debt, and it's backed, the assets are back of the bonds are backed by mortgages. So, or other hard collateral. Andesite Blue is another great company. If you're interested in corporate income bonds, you should check out Andesite Blue. These are companies that I can provide you a lot more information on. But the point is, don't get trapped into following rating agencies. So premium par, let's say that the face value of a bond's 1,000, the price would be quoted as 100, the market price would be 100. In that example, the bond's trading at par. Say the face value is 1,000, the price is quoted at 102. In that case, the market price is 1,020. It's trading at a premium to par. So these things are important. Discount to par means the opposite. If it's trading at 99, it might have a market price of 49.50. It's trading at a discount to par. So that's how that works. Floating and exchange rates. This is something that's so important when you're buying bonds. You need to consider the currency of the bond, because a lot of people, they'll compare bonds and they'll just look at the interest rate, and they're not even looking at the currency that the bond is denominated in, which has a tremendous impact on the actual real rate of return. So here's an example of the British pound versus the US dollar, the long-term history. If we went back to towards the end of World War II, 1945, 1 British pound sterling would buy 4 American dollars. But if we, over the decades, go forward now, the 1st of January 2023, 1 British pound will only buy $1.20. So that is a massive, massive loss for the British pound. It has depreciated massively against the US dollar. So if you're looking at a bond that pays 8% in British pound sterling and 8% in US dollars, you should think hard about whether the long-term history of that is going to continue, because that can have a massive impact. Here's an interesting graph that shows the bond price in the year 2022 when Russia invaded Ukraine, that wicked invasion. So on February 24th, Russia invaded Ukraine, and you can see here the Ukraine USD bond. So this is a bond denominated in US dollars. It was trading at around par, a little bit of a discount to par back before the invasion. But when Russia actually invaded, you see how the price dropped. It was a steep fall in value. So those bondholders had a bad day, and of course, all of the people that were killed had a terrible day. All of the families that were impacted by this, a terrible situation, but the bond market was impacted. But if we look at the 1-year Ukraine bond yield, we can see here that here's February 24th, the yield went up. And the only reason I'm showing you this is that there's inverse relationship there. So what about the Russian government bond yield? Well, Notice the Russian government bond yield here, it jumped up. That means that the price of the Russian government bond fell because the yield increased. And you can see here that it caused a massive increase. At one point, the yield went as high as 19%. There were capital controls that were implemented that were done to try to create demand for the ruble. Russia stepped in and tried to implement capital controls. These capital controls, they had a lot of skeptics who have called the ruble's strength artificial. Now we look at Russian bond prices, and we see here that once again, we're looking at the yield. Yield goes way up. Here's Lukoil bond price. This is a corporate bond. We're not talking about a government bond here, but we see here that it was actually trading at a premium to par. And then the invasion happened, drop in bond prices, and this is everything that transpired there. But what about the U.S. market? This is actually quite interesting to look at. We're looking at the 24th of February, 2022, and we see here that this line here shows the U.S. 10-year Treasury yield. And you notice that the 10-year Treasury yield went down. So if the Treasury yield went down, that means the price of the U.S. 10-year Treasury went up. So why did the price of the U.S. 10-year Treasury went up? Well, it's called flight to safety. So people are selling bonds in Ukraine, they're selling bonds in Russia, and they are looking for a safe place to put that money. And actually, that created the increased demand for U.S. government bonds, 10-year Treasury, and you can see it right here. But this is quite interesting because it happened right there. There's February 24th, but you can see that this is when the report of the attack happened, and you can see that the trend was reversed. So the Ukraine government bond prices, they climbed 50% in 2 months as creditors became more optimistic. That was as of August 2023. And the Kiev foreign reserves have climbed to an all-time high of 41.7 billion. So there's a lot that is going on there, and it's important to think about this. So another thing that you hear when people talk about bonds is an inverted yield curve. And what is an inverted yield curve? Why do people talk about so much? Well, it's supposed to predict recession. It's supposed to be a leading indicator. So why buy bonds if inflation is rising? Sometimes people will say, oh, I'd never buy a bond. The government's printing money. I'm not going to buy a bond. I'm too smart. They say that all the time. Well, you know, an investor should keep part of their portfolio so it is balanced, where if you just have 100% of your money in stocks and then the market collapses and you don't have anything in bonds, then you're not going to be able to sell any bonds to buy stocks when the market collapses. So it's a hedging strategy. We look here at a chart that shows 1987 Black Monday. And if you had, say, a third to half of your portfolio in bonds, you can take advantage of price drops. You could sell bonds on a day like this, and you could buy stocks. So that's a good reason. A couple of reminders. Please fill out the sign-in sheet if you're here. Actually, everyone here I know, so you don't have to do that. And if you have any friends or colleagues that you think would benefit or be interested, please feel free to invite them to the meeting. We have these meetings every Sunday. So I'm also available for personal mentoring. If you're on the internet and you see this and you think, yeah, that's great, I'd like to learn more, get in touch with me. I've got some supplemental material. I'm not going to go through it here, but I'll email that out, and I'll get a copy of this presentation to everyone. So that is it for the presentation. And I'm going to go ahead and stop the recording, and then I'll take any questions.